Hello everybody, welcome to this episode of DM Tutorials series of tutorial videos. Today's topic is Capital Assets Pricing Model, or commonly known as CAPM, developed by William Sharpe, the Nobel laureate. Now CAPM, or Capital Asset Pricing Model, or CAPM, is a critical topic of financial management and is very important from examination's point of view. It's a very important topic in different courses like CFA, CPA, CA, ICWA and MBA. Also in MSc in some certain universities. Sorry. So understanding CAPM needs lot of attention and lot of concentration. So please try to be attentive in my lecture. Now, as Markowitz postulated that a rational investor would determine his or her investment according to the return he or she is getting from certain asset. That is, the utility of a rational investor is function of two things. One is the return, that is the mean, and its variance or its square root, that is standard deviation. Okay. Now, according to Markowitz, if a portfolio consists of two assets, say X and Y, the expected return of the portfolio is RP. The return of X is Rx and of Y is Ry, then Rp will be equal to Rx into M plus Ry into N. M is to N is equal to the proportion of the securities X and Y Well, so this was Professor Markowitz's postulation. William Sharpe challenged Markowitz's postulation on the ground that if an investor is rational and he prefers that stock whose mean is more and prefers that stock whose variance is low, then what is the relationship between risk and return? So the risk return trade-off is the cornerstone of understanding CAPM. Now I am going to CAPM. CAPM is a model to determine the value of a stock. The CAPM structure is made with the formula ER is equal to RF plus beta into RM minus RF. So three things are there. One is expected return, one is risk-free return, and another is beta. Four things actually, and market return. We'll come to this one by one. Before that, let us learn how risk-return trade-off works. Now, as goes the old saying, no risk, no return has a very big significance in investment. Yeah, it is true. If an investor does not want to take any risk, he won't get any return. So, if we measure risk on x-axis and return on y-axis, we'll get a straight line like this starting from the origin. At this point, at 0, there is no risk, there is no return. As the investor goes on taking more and more risk, his return also increases. This is the risk-return trade-off. Risk-return trade-off. Okay. Yeah. Now, as we all know, there exists a term risk-free return which has been incorporated in the formula as developed by Sharpe. That is, ER is equal to RF plus beta into multiplied by the difference between RM and RF. Now what is RF? Risk-free return is the return that an investor gets by investing in government bonds or government securities, treasury bills, etc. So government bonds, bills, in these cases there is no risk. The whole money is insured by the government, and a return is also insured by the government, although the return is very low. It varies from 1 to 3% according to jurisdiction. Now what is, I am coming to beta at a later stage. Now we come to RM. RM is the market return. That is the return one gets from the market. That is the average return the market is providing to the investors. Okay. Now beta, this is very important. Beta measures the volatility of the stock. It measures the volatility, that is the riskiness of the stock. Riskiness of the stock. Okay. So this is the formula. Expected return is equal to risk-free return plus beta multiplied by the difference of RM and RF, that is market return and risk-free return. This is called market premium. This is called market premium. Why it is called market premium? You see, as the investor takes risks, he must expect more return. This is the rational behavior, rational attitude of human beings. So, sorry. As the investor's expectation becomes more, he has to take more risk. So, for that risk, for taking that risk, market rewards the investor. For taking that risk, market rewards the investor. That is called the market premium, because that means the investor is taking the risk for which he is getting that premium through return. Now, beta is the volatility of the stock. Volatility in respect to what? Volatility in respect to the market. Now I am erasing this part. If beta is equal to 1, this means the stock is exactly as volatile as the market. The stock is exactly as volatile as the market. The stock moves in the same direction as the market moves. If beta is greater than 1, beta equals to 1 means volatility of stock is equal to volatility of the market. Beta greater than 1 means volatility of the stock is more than volatility of the market. Beta less than 1 means volatility of the stock is less than volatility of the market. Okay. Yeah. Now, if we draw a diagram, incorporating risk-free return and risky returns, what we will get? Return and beta. Say this is risk-free return. Okay. Now, if you draw a line, straight line from here, we get what? We get SM or security market line. Security market line. Security market line combines risk-free return and risky returns. Suppose a stock lies here. A stock lies here. Suppose here beta is equal to 1. This means the stock is performing exactly as the market is performing. Okay. Now there can be many stocks lying here, etc. Now you see, above this line, as the investor moves from here to here, you see his return is increasing. His return is increasing as he moves from here to here. His risk is falling. Okay. The same logic applies to other stocks lying above this line. Correct? Now what about these points? See, if the investor moves from here to this point, what is happening? At this point, this is the risk. This is the risk, and this is the return. That means return has increased by this much, but risk has increased by this much. So these stocks are underperformers or underperforming stocks. So stocks lying below SM and right of this line are underperforming stocks. In the same way, stocks lying above SM, these are called overperforming stocks. Now, how the investor will act rationally in this case? The stocks, those are overperforming the market, are undervalued. These are undervalued because these stocks are performing better than the market, whereas these stocks are performing worse than the market. So these stocks are overvalued. Okay, so we have learned CAPM model, the CAPM formula, that is the expected return is equal to risk-free return plus market return multiplied by the market return plus beta multiplied by the difference between market return and risk-free return, that is market premium. That is expected return is equal to risk-free return plus beta into market premium. Okay, and this is security market line, SM line. Stocks lying on the right side of SM line are underperforming stocks, which can be called overvalued stocks, and stocks lying above SM line are overperforming stocks or undervalued stocks. Okay, this is enough for today. I hope you have enjoyed this video. Your comments, your queries, etc. will be highly appreciated by us. So please don't hesitate to send comments. Okay, thank you for watching. Goodbye.